Welcome back, everyone. I am just thrilled today to have Richard Barkham on. I've been watching Richard's outlooks for many years, just as an audience member, so I'm thrilled that he agreed to come on our show today. Many of y'all know Richard. He is one that doesn't need much of an introduction, but he is the former global chief economist for CBRE, and he recently stepped down from that position, but of course, still watching the market closely and is acting as a senior fellow and lecturer in real estate at Harvard and is a professor of the practice at University of North Carolina. Richard, thank you so much for joining us.
Well, thanks for having me.
And I'm very happy to see that it looks like you just recently either made a move or are planning a move. Give me some information on what I'm looking at back there.
Yes, I just moved from the downtown of Dallas into Addison, and I'm probably going to move to another location, possibly back in the UK. So you see a bit of a disorganized apartment behind you um, with boxes, and you can probably see my bike as well. It's really surprising when you move to realize how little you actually use in your house and how little you can actually get away with. Any case, disorganized house, but hopefully a clear mind.
Excellent. Now, I love that we're catching you in your natural state. And that move from downtown to Addison, I mean, that's almost like two different worlds, but to the UK will be an even bigger jump. So,
Yes, well, what I've discovered really, and I should have known being an urbanist, that Dallas is really a city of the suburbs. And you only really experience Dallas if you live in the suburbs. Now, I'm not sure you'd call Addison, it's a kind of inner beltline suburb,
sure.
but it's got great amenities. And I've really, I've been here for 3 months and I've really enjoyed it.
Amazing. Awesome. Well, again, thank you for joining. We're going to run through some questions just to get Richard's outlook for the year, his economic outlook. We'll start macro and then we'll go into the micro of commercial real estate and hopefully have a little bit of fun in between. So let me ask you this because I've been really interested to see different economists being asked this question and how they answer it differently. They seem to be divided on whether recession is imminent or not. And whether this period is just sort of a normalization after the rapid expansion that we saw post-COVID. So I'd love to hear your view on the threat of recession and what you're sort of watching to formulate that opinion.
Well, I don't think a recession is imminent at all. I think the economy is motoring along quite nicely. Now, there are some issues. We've heard about the K-shaped economy. I think the wealthier income deciles are probably doing better than the less wealthy income deciles. And I'm concerned that the economy isn't generating jobs. The labour market seems to be frozen. So, but in terms of GDP growth and investment and consumer spending, for the time being, it's all very nice, very good. Inflation is trending down, and we'll probably see some interest rate cuts. What am I watching? I mean, I think having said all of that, I do think the risks are quite high at the moment. I don't think that necessarily means we've got a recession, this year or next. But when the economy, consumers' confidence is weak, and consumers, I think, get a lot of the confidence out of the labour market. And the unemployment is not high, but the fact that jobs aren't being created, I think, partly because of the impact of tariffs has made and also the impact of AI, I think, is making companies reluctant to hire. I think when you've got that sort of frozen labour market, the possibility that consumers would suddenly get frightened and rein in their spending is probably quite high. And if we got a really big jolt to the stock market, then I think that could have a negative consequence. But that's not necessarily imminent. That's just a risk factor that I'm watching as we go along.
So staying on the trend of the frozen job market, where does immigration policy sort of fall into your outlook for the year? Are you concerned that that could have bigger impacts on job growth or decline? Where do you sort of fall in that conversation?
Well, I think we've got to remember that 3.5 million Americans are retiring every year. Boomers are retiring. And I think if we move to a situation of very low immigration, it doesn't take very long, maybe, over the next 5 years, for the US labor force to start shrinking. And I think that would be quite negative for economic growth over the next 5 years. Japan is another economy where you've had the labor market, it has very low immigration and has a labor market, a labor force that's shrinking. But I don't necessarily think there's anything imminent, any imminent problem from low levels of immigration. It's more of a long-term impact, which could be quite negative. Now, it could be offset by productivity growth, and that seems to be picking up a little bit. But on balance, economies where the labor force is shrinking, tend to be low growth economies as well.
So I'd love to ask you a little bit about how that longer term risk could impact commercial real estate, because as you know, these projects take years to conceive, plan, and then, go vertical. But before I do, you mentioned interest rates before, and obviously that's a key indicator and you're watching that. So the Fed held rates steady in January, but two small cuts are still anticipated by the end of the year. Um, I feel like over the past few years, it's been a lot of, oh, these cuts are anticipated and then they don't come. So how do you see the rate trajectory unfolding this year? Are you of the mind that there will be small cuts, or is there a possibility that we could be in a higher for longer scenario this year?
I mean, I think there could be a couple of cuts over the course of the year, and I think that the most recent fall in inflation has, set the stage for that. And the weaker labour market we all referred to is also of concern to the Fed. A concern would be, and it would, I think, have been a very strong concern if Kevin Hassett had been nominated for Fed chair, because and because I think that would have raised concerns in the market that the Fed was going to ease back on its inflation concerns and follow the administration's desire to run the economy hot. I think with Kevin Warsh being appointed or being nominated, then there is much less concern about that. And I think, we will get those couple of cuts. My concern is either of those two Kevins, if they signal to the market that they're more concerned with growth than inflation, then that could have quite negative consequences for the dollar, for long-term interest rates, and of course that feeds back into real estate. But as I say, of the two Kevins, I think Kevin Warsh has got much more inflation fighting credential about him, and I think that will allow him to be able to make a couple of cuts in interest rates. But beyond that, I don't see any real reason for interest rates to go down, not with, as I've said, the economy is growing pretty strongly.
So we talked a little bit about change of leadership at the Fed when we had lunch together a couple months ago. And you just mentioned, there could be a change in direction based on who becomes the Fed chair. Is that uncertainty an issue for commercial real estate? We've talked a lot about the last few years how interest rate uncertainty has really been a huge factor in the decisions that developers and investors and lenders are playing. Is a change of leadership at the Fed, do you think that's something that they're factoring in right now? Or do you think that's something that's kind of, out of sight, out of mind?
Well, firstly, I do think it's important for real estate because it affects the bond market. And if the market gets the idea that the Fed isn't going to bear down on inflation, then those 10-year Treasury rates will go up again, and that will feed into the real estate market, no question about it. And I think I can understand the administration's desire to run the economy hot, because when you've got the economy running hot, you've got productivity growth and you've got wage growth for folks, perhaps even at the bottom end of the scale. But the bond market is central to people's expectations about real estate returns and real estate values. And if the Fed loses any degree of kind of inflation credibility, which, as I've said, with the appointment of Kevin Walsh, I think there's much less danger that that will happen. But if it does, then that could be quite negative for real estate. I'm not saying it's completely negative because interest rate cuts clearly boost the economy and boost the fundamental demand for real estate. But of course, the higher bond rates feed through into cap rates, and that would certainly have an impact on values.
So let's stay zoomed in on commercial real estate. It's been obviously a turbulent few years for CRE. There's been a lot of uncertainty, and that has caused many to sort of just hold back on making any big decisions. And we've seen that at a broad level industry wide. We've also seen it in the C-PACE market that things have, slowed down a little bit. What do you think the biggest tailwinds will be for commercial real estate over the next, let's say, 5 years? And also, let's also talk about the risks, whether that be capital markets, liquidity, the wall of maturities that we hear about, policy shifts, things like that. We'll start with the positive. Let's start with the tailwinds.
I mean, so the tailwinds, for real estate are always, GDP growth. And if the economy continues to motor as it is now, then that will be positive for real estate. I also think, it's a slightly odd thing to say, but the lack of, you know, the COVID era stimulus, as well as strong fundamentals, stimulated quite a big supply surge, both in the industrial sector and also in the multifamily sector.
Yes.
Those two supply surges are now being absorbed. And in the retail sector, there was no supply surge. It's kind of, it's an odd thing that bricks and mortar retail is probably undersupplied, particularly in the Sunbelt markets. So I think a combination of economic growth and relatively muted new construction
Hmm.
is going to be, pretty good for fundamentals, and we'll see, vacancy trending down from this point on. Now it's probably got a little bit further to go in industrial, but I think we'll begin to see vacancy, trending down, even in the office sector. So, I think that is a tailwind. It's always good for real estate when that vacancy is coming in because, the growth motivates the occupier, but also a sense that the space that they kind of desire might not be available in 18 months' time is also a good motivator.
Yeah.
So, I think those are tailwinds for the sector.
And then in terms of headwinds, I do want to ask you about the immigration crackdown, and you said that that's a longer term risk. How does that impact commercial real estate when you have an expectation that there will be job growth, that there will be less job growth in the next 5 years?
Well, I mean, I think, there are parts of the real estate world which are kind of basically operational assets.
Hmm.
Hotels, maybe kind of retail as well to a certain extent. And those sectors, if they can't get the labor that they need, are going to face rising costs, and those rising costs, to business because of the lack of labor, equate to less ability to pay rent. And even in the industrial sector, I think kind of labor supply is quite an important component still. So to the extent that companies can't get labor, then that forces up their costs. But also think the lack of labor, it also is forcing up construction costs, or it's pushing up construction costs, which in the one sense is a negative because we like to see construction activity, but in terms of existing assets, the more that there's a constraint on supply,
Hmm.
the better the rental growth is going to be over the next 4 to 5 years. So I think it's a mixed bag. The lack of immigration.
Hmm.
Um, some positives, some negatives.
Yeah, I mean, there's been definitely people who have said that there was some overbuilding happening, post-COVID, and maybe it's a good thing for less to be constructed so that we can sort of normalize out of that period. But certainly, if there's demand for more multifamily and we need construction crews, then I guess that could also be a negative. So I see how that could kind of go either way. Um,
Exactly, exactly what I was saying,
yeah.
and more elegantly put.
I don't know about that, but thank you. Any other major headwinds that we should be aware of?
Well, I think, as I say, I think the spread between cap rates and bond rates, it's still relatively low. Cap rates have adjusted upwards and values have fallen, but compared to historical averages, there's still quite a skinny spread, I would say. And you know, why is people will accept investors will accept a skinny spread when there's quite obviously going to be good rental growth, and we do have conditions that rental growth is going to be reasonable. But I think all of the uncertainty around AI and how that impacts on real estate markets, and we've seen it in the last week with a kind of 15% drop in CBRE stock, and all of the main commercial property advisors have seen a drop in their stock values because of worries about how AI is just going to impact their business model, but not just the business model, the wider pattern of usage
Hmm.
in the economy. Anyway, it's a long-winded story, but I think the level of uncertainty about occupier usage due to technological change merits a higher spread between those cap rates and bond rates. So I think there may well be, a situation where to really revive investment volumes, which have been, pushing up quite nicely. Um, but I think we might even have to see further reduction in values and further increase in cap rates just to account for the uncertainty that's in the economy right now.
Okay, and you mentioned AI, and that's actually a really good segue into another sort of more niche real estate question that I have for you. There's been some chatter and even some reports in the media that there are developers sort of waving the red flag on the warning flag, I should say, on data centers. Obviously, demand for data centers has been through the roof, and development has followed in insofar as it can with available power. Um, what is your sort of view on the risk of overbuilding in that segment of the market? Technology obviously changes very fast. Do you think there is a risk of obsolescence in some of those buildings? I would just love your thoughts on that debate and whether you think that level of development is sustainable.
Well, I mean, if you look at the trajectory of the AI industry, and we're just at the starting phase. A friend of mine's been using AI in research, and I use it. And it's a bit like having you know, um, a not very high grade research assistant. It's quite useful, but there's a ton that of progress that can be made in AI, and it's being made at leaps and bounds, and that just implies that you need more processing power or you need more data storage. So I think that makes me optimistic that the use case for data centers is going to remain robust. What but we are running into capacity constraints and we are running into power constraints. I don't think we're exceeding. I think if you sweat the US grid, and you can get maybe another 20 or 30% of power out of it, which is what we're going to need by 2030 to fuel the AI and data center boom. I just think that necessity is the mother of invention, and it, you know the industry is potentially prone to breakthroughs in processing power. Now, I'm not a technologist. I don't know whether that
Mhm,
can happen or not, but
mhm,
you invent new chips that give you more capacity for any given level of energy input and space input, then I think the data center industry could be vulnerable to that. And we know that given the heat that's in the sector, the best and brightest minds are going to be, focused in on improving data center productivity. The development of the data centers will continue apace,
mhm.
driven by the strong demand that's out there. I think that, but I do think the risk is a change in data center technology, and that will happen when it happens.
So I just want to end on a question about how capital stacks are going to look over the next few years. So obviously, piecing those stacks together has been a puzzle for the past, 3 years, I'd say, and that has given a lot of us in the CPACE world. It's kind of been a tailwind for us, as it's been a really big opportunity for us to be part of the equation. I'd love to hear from your vantage point. Was that the increase in alternative financing? Sources. Was that a cyclical response to tighter bank lending, or will that be a more permanent shift in the way that people assemble their capital stacks? Where do you see sources like CPACE fitting into the equation over the next cycle?
Well, we talked about interest rates, and I think CPACE finance rates are very competitive. So I think when bond rates are trending 4.5%, then I think folks are really trying their hardest to get their cost of capital down. So I think the C pace is a, will be attractive to a market like that, um, and I think also, but having said that, I think the kind of, as I said earlier, the overall level of construction is going to be kind of subdued, I think, for 2 or 3 years. So, CPACE finance for new construction or refurbishment probably, might run into a little bit of a headwind there. But
Mhm.
I think, in terms of cost of capital, then CPACE is going to continue to, to grow as a proportion of the overall real estate funding, um,
Amazing.
a real estate funding universe.
Well, from your mouth to God's ears, Richard. We sure hope so. Thank you so much for taking the time to speak with me today. Our audience is going to be so excited for this. Richard is available. If anyone is interested in contacting him, you can message him on LinkedIn under his name, Richard Barkham, pretty easy to find. But thank you so much. Really appreciate your time.
Oh, my pleasure. Good luck with everything.
Thanks, Richard.